Chapter G, Reporting. In this chapter we're going to look at audit reports. The audit report is the end product of an audit. It is the report that the auditor writes, which is included in the final set of financial statements, and which allows people that are reviewing the financial statements to see what the auditors think of the financial statements contained in the report. It's worth pointing out that the audit report is actually the only piece of the audit that shareholders get to see. Of course, shareholders don't generally work for a company, so they won't be privy to the private conversations that the auditors and the directors have. And therefore, it is important that you understand the nature of an audit report, the purpose of an audit report, and more importantly, as far as the exam is concerned, what an audit report looks like. So let's have a look at audit reports here, and you can see that we have an ISA which governs what we have in this chapter, ISA 700. Again, we don't need to know the name and the number of the standard, but it is the standard on audit reports. And the ISA suggests that the primary purpose of an audit is to prepare an independent opinion on a set of financial statements. So that's why we've skipped forward to this chapter after chapters A and B. Worth doing this chapter relatively early on just to get to see where we're heading with the audit. So let's just have a look at this idea of unmodified audit reports, and as we'll see a bit later on in this chapter, there is very much modified audit reports examinable in this paper as well. And what you can see listed out here are some of the key features of an audit report. The title, introduction, responsibilities of the directors and auditors, the audit opinion, the date the audit report is signed, and then a signature. Now, it's worth just pointing out that over the page here you have an illustration of an unmodified audit report. And I want you to think of this unmodified audit report as essentially a pro forma audit report. And that's an important point because it's worth pointing out that auditors don't generally make up audit reports. They can't use their own language. The language that they have to use in an audit report is set out in the ISA. So if you were to look at the audit report for any company in the UK, it should look exactly the same as the audit report you have in front of you now. Literally word for word the same. It's a pro forma. You can't just make up an audit report according to how you feel the audit went. And this is good really because this consistency of approach means that you should be able to compare one company's audit report with another. And if they don't look the same, as this pro forma, then that will tell you that something is up. So there's a couple of things I need to point out here. First things first, you do not need to know this pro forma. You will not be asked in the exam to repeat this pro forma, but keep an eye on it as we turn back to the previous page and run through some of the key content. So just make sure you just keep flipping backwards and forwards between what we're doing now and the actual report over the page. So first of all, the key contents, and this is what you could be asked in the exam, not to reproduce the report. Again, I'm going to make this absolutely clear, you do not need to know the audit report as a pro forma, but you might be asked what sort of things the audit report contains. And this is what you need to learn. So first things first, a title, addressing the report to the shareholders. Now if you look at the report over the page, it actually refers to an appropriate addressee. Well, that's the shareholders. Okay. Why doesn't it say shareholders in the pro forma? Well, in some countries the appropriate addressee might not be the shareholders, it might be a bank, for example. That's why it doesn't actually physically say shareholders in the pro forma. But if you look at an audit report, you will generally see it addressed to the shareholders. Again, it's the only piece of the audit that the shareholders get to see. So first things first then, a title. Then what we've referred to on the previous page as an introduction. what has been audited. And you can see here that it's the financial statements that have been audited, and just in case you're in any doubt as to what that means, financial statements, it then goes on to say what that is. The statement of financial position or balance sheet, the statement of comprehensive income or income statement or P&L account, statement of changes in equity. You'll see more of this in your F7 studies. A cash flow statement, again, see your F7 studies for more detail there. And then other information, what we're going to refer to as the notes to the accounts. And if you look through a set of typical financial statements, let's say that they're 100 pages long, you'll probably find that 60 or 70 of those pages contain this supplementary other information. So that's what we've audited. Then we distinguish between management's responsibilities and auditors' responsibilities. Management are responsible for the preparation of the financial statements. That is actually a legal responsibility. Even if they've actually delegated that to other people, ultimately management must prepare the accounts. The auditors, on the other hand, simply express an opinion on those financial statements, hopefully true and fair. So again, there is a distinction between the responsibilities of the management and the auditors. Then there is a brief paragraph just explaining what an audit is, basically obtaining audit evidence to prove the figures in the accounts, the amounts and the disclosures. Don't need to know much about this paragraph, it just briefly explains what an audit is. The most important paragraph, you could argue, is here, the opinion paragraph. If you are paying your auditors X thousand pounds to do your audit, this is the bit you're interested in. And here is the key phrase, true and fair. Recall that phrase from Chapter A. True and fair is the audit opinion you want from your auditors. It is basically the thumbs up. In our opinion, there are no material errors. Okay. And this true and fair opinion has its own piece of jargon. It is often referred to as an unqualified opinion. And it's worth getting used to that phrase, unqualified. Unqualified opinion means true and fair. The two things mean exactly the same thing. So what I want to point out is that in this pro forma unmodified report, part of that is an unqualified opinion. Now, one of the key confusions that sometimes students have in this paper is getting the word unmodified and unqualified mixed up. They do not mean the same thing. Unmodified refers to the whole report, this whole page of information that you have in front of you. So unmodified refers to the whole report. Part of this unmodified report is this unqualified opinion, or if you prefer, true and fair opinion. So notice that in the pro forma unmodified report is included an unqualified opinion. Now, I just want to make this absolutely clear. An unqualified opinion is a good thing. Again, some students get confused and say, well, surely you want a qualified report. No, you don't. You want an unqualified audit report. That's good news. Don't get confused by unqualified report and qualified accountant. Of course, only a qualified accountant can produce this report, but it is good news to have an unqualified opinion. The report is then simply dated and signed by the auditor just to give that stamp of approval. Now that's the pro forma ISA according to ISA 700. I've just pointed out here that if you are studying this paper under the UK standard, the pro forma is very, very similar indeed, but there are also a couple of references to the Companies Act in there. I would refer you to your UK study text if you're studying the UK standard, but I have to say, if you just learnt this as the pro forma, that will get you the vast majority, if not all of the marks in the exam. They are very, very similar indeed. Okay, so that's what we refer to as the unmodified report. And really, there's only one possible question, I would say, in the exam on unmodified reports, and that is perhaps the key components, the key contents as we've listed here. You might be asked about the fact that it is a standard, a pro forma, and is that a good thing or a bad thing, but really there's not much to say about unmodified. Most exam questions ask what happens if you're not satisfied in some way. That moves us on to this second paragraph, modified audit reports. As it suggests here in the opening paragraph, exam questions are much more likely to focus here. So let's just start with what a modified audit report actually is. Just going back to the previous page for a moment, the unmodified audit report. I refer to that as a pro forma audit report. And again, I suggest that you look at a set of accounts for your company or some client companies if you work for a firm of accountants, just to satisfy yourself that generally the audit report looks very, very similar to that. If, however, you change the audit report, if you're not going to use this pro forma, then by definition you have modified it, you have changed it. And the idea with a modified audit report is that if you change it even by one word, then you've modified it in some way. The exam is likely to ask you how and why has it been modified. Now, it's worth pointing out on this page that I've given you a modified audit report with an unqualified opinion, and then a bit later modified audit reports with a qualified opinion. Now this is where you can see the confusion sometimes arises. Modified does not mean qualified. The idea of modified and qualified are not the same thing. So again, let's just go through this slowly. For most companies, they have an unmodified pro forma report which contains an unqualified true and fair opinion. If you change this unmodified report in any way, then you've modified it, but that doesn't mean you necessarily qualify it. So, for example, looking at our modified audit reports in a bit more detail. And let's start with modified unqualified opinion. There is only one example of this, referred to as an emphasis of matter paragraph. Now don't forget that an unqualified opinion means true and fair. Okay, so we are saying that we're happy with the financial statements. There are no material errors in the accounts here, but yet we felt the need to modify or change the audit report in some way. Why? Well, an emphasis of matter paragraph re-highlights a significant matter in the accounts. There is nothing wrong here, we're just re-highlighting something, and as I've just gone on to say back here, this matter is already disclosed elsewhere in the accounts. That's why we are re-highlighting it, i.e. we're highlighting it again, so that this matter appears actually twice in the accounts. With an emphasis of matter paragraph, there are no problems. Now what we're going to see later on in this chapter is that the sort of problems that we see are disagreements and limitations on scope. We're about to come on to those two matters, okay? But there is no disagreement and there is no limitation on scope. Notice that we have an unqualified audit report. Everything is okay. There are no material errors, there are no disagreements, there are no limitations on scope. All we're doing is we're re-highlighting something significant. Now, the sort of things which could be re-highlighted could be, for example, an uncertainty relating to the future outcome of a litigation. Imagine you're auditing a client and you're absolutely satisfied with all of the numbers and all of the disclosures in the accounts. There are no problems in the accounts at all. It just so happens that your client is being sued. Okay? They've dealt with this in accounting terms correctly. So, for example, they have a provision if they feel the need for a provision, or if it's a possible payment, they have a contingent liability. Now again, I remind you that provisions and contingent liabilities are examinable in this paper, so if you need to refer back to your F3 or F7 notes at this point, then I would encourage you to do so. A provision is needed where there is a probable payment. A contingent liability is disclosed where there is a possible payment. Now, if that has been treated correctly in the accounts, there's no errors, everything's fine, but because this is an important thing, the company being sued, we want to re-highlight this matter. So notice it's already appropriately disclosed and accounted for elsewhere. There are no problems, but we just think this is so important, we want to re-highlight it. But the accounts are still true and fair. If there are going concern problems, again, there are no errors in the accounts, but the company is on relatively shaky ground in terms of going concern. Again, that will be fully disclosed in the accounts, but we again will re-highlight it in our audit report, just so that people don't miss this matter. So, emphasis of matter. They re-highlight significant elements that are already disclosed elsewhere in the accounts. That's modified, but with a true and fair, unqualified opinion.